we would like to begin the presentation of MIRAI Corporation's 20th fiscal period financial results. I will focus my presentation on the executive summary at the beginning, the financial summary and forecasts in Section 1, and the operational highlight in Section 2, while also touching on parts of the portfolio management in Section 3 and the ESG initiatives in Section 4. During the 20th fiscal period, the J-REITO market recovery that began in the summer continued, and by November 2025, the J-REIT index rebounded to 2,000 points for the first time in about 3 years. After reaching 2,000 points again in January, the index dropped to the 1,800-point range in March amid rising interest rates and heightened tensions in the Middle East. It is currently trading in the 1,700-point range. Despite these volatile market conditions, the fundamentals of the real estate market remain extremely strong, and the office market in particular is seeing further declines in vacancy rates and increases in rents. MIRAI's rents are also rising steadily, not only for large-scale offices, such as those in the Bay Area, but also for other mid-sized office properties. Now, let me begin. First, please take a look at the executive summary on page 1. The DPU for the 20th fiscal period was 1,349 yen, exceeding the initial forecast by 49 yen. In addition, the NAV per unit stood at 54,920 yen, demonstrating steady growth. In terms of external growth, both the unrealized gains on MIRAI's portfolio and the number of properties in the pipeline have increased. Additionally, from the 21st to the 22nd fiscal periods, we will implement asset replacement to improve portfolio profitability and strengthen resilience to inflation. Regarding the portfolio management, leasing business revenue across the portfolio is on an upward trend. We have achieved steady rent growth in the office while maintaining high occupancy rates. In the hotel sector, although some properties were affected by the decline in Chinese inbound tourists, the combined rent from 5 properties with variable rent reached a record high since the acquisition. From a financial perspective, while the average interest rate for debt rose slightly from the previous fiscal period to 0.98%, the proportion of fixed-rate debt remained at a relatively high level of 85.6%. In addition, we have formulated an ESG roadmap toward net zero by 2050 and have begun implementing the initiatives. I will now move on to the financial summary and forecasts in Section 1. Pages 4 through 6 provide a breakdown of the results for the 20th fiscal period and the forecasts for the 21st and 22nd fiscal periods, organized by expense category and by asset classes. Next, please turn to page 7 to see the factors affecting the change in DPU. This page provides an overview of MIRAI's DPU for the 20th fiscal period. Please refer to the comparison with the previous period's results on the left. Disposition gain declined due to the absence of the gain from Tokyo Eisei Gakuen Senmon Gakko recorded in the previous period, and debt cost increased during the 20th fiscal period. On the other hand, the full period contribution from MI Fuchu Technical Center, which was acquired through asset replacement, along with penalty received due to a tenant's departure from a large-scale office, and increased earnings from both retail and hotel assets, resulted in DPU of 1,349 yen, an increase of 60 yen from the previous period. Compared to the initial forecast on the right, the actual result was 49 yen higher due to the increase in revenue from large-scale offices mentioned earlier, and hotel rent exceeding initial forecasts. Next, please turn to page 8. This page provides the forecasts of the DPU. Comparing the forecast for the 21st fiscal period with the results of the 20th fiscal period, we expect a decline in revenue from large-scale offices due to the absence of penalty fees from tenant departure recorded in the 20th fiscal period, as well as a decline in revenue from hotels, given the current conflict in the Middle East. Although we anticipate an increase in earnings due to the disposition gain on the sale of Things Aoyama and the revenue contribution from newly acquired properties, including Smile Hotel Kumagaya, which we will acquire as the replacement, the DPU is expected to be 1,290 yen, a decrease of 59 yen from the previous fiscal period. For the 22nd fiscal period, despite factors such as rent increases for large-scale offices, improved hotel occupancy rates driven by the stabilization of Middle East conflict, rent increases resulting from the introduction of variable rent for multiple hotels before the expiration of their leases, and the contribution from new acquisitions including Smile Hotel Kumagaya, we expect DPU to be 1,225 yen, a decrease of 65 yen from the previous period, due to the significant impact of the absence of the disposition gain recorded in the previous period. Now I would like to move on to Section 2, Operational Highlight. First, here is the progress on the Midterm Management Plan 2028. Please refer to page 10, Progress of MIRAI Midterm Management Plan 2028. In the Midterm Management Plan, Smart Defense, Enduring Growth, announced during the 18th fiscal period, we have set 3 quantitative targets. First, regarding the DPU target, we aim to achieve a DPU of 1,350 yen for the fiscal period ending April 2028 through annual growth of 2% or more. Although we have not yet reached this growth rate due to rising operating and debt costs, we believe it remains achievable for the following reasons. First, we are seeing a stronger trend of rent increases for both large and medium-sized offices. Second, in the hotel sector, we expect rent increases driven by the recovery of international tourist arrivals following the stabilization of the Middle East conflict, as well as rent revisions at lease renewals. Furthermore, while we have not set a specific target date, we aim to reach an AUM of 250 billion yen in order to enhance portfolio diversification and improve liquidity. The last target, the credit rating, was achieved by the 19th fiscal period. Please refer to Changes in the Market Environment and Management Strategies on page 11. As described on this page, MIRAI employs an integrated management strategy that coordinates the asset, liability, and equity sides of the balance sheet. On the asset side, variable rent leases and leases with less than 2 years remaining account for 62.5% of the portfolio. We will seek to increase portfolio revenue by securing rent increases and introducing variable rent leases for office, hotel, and urban retail properties as their leases come up for renewal. On the liability side, only 53.6% of our debt is sensitive to interest rate fluctuations. Relative to the proportion of assets with contracts with upside potential, this indicates that our portfolio is well positioned to withstand rising interest rates. Furthermore, we will manage our debt costs by refinancing maturing borrowings with floating rate debt. On the equity side, we will strive to improve NAV by increasing appraisal values through rent hikes and by acquiring properties with unrealized gains. Please turn to page 12. This page outlines specific steps toward achieving the DPU target of 1,350 yen. In terms of external growth, we expect a positive impact from asset replacement using our approximately 15 billion yen pipeline of high profitability assets, as well as from acquisitions leveraging our financial capacity. Internal growth is the primary focus of our efforts among the various initiatives. Specifically, in the hotel sector, we expect positive impacts from the recovery of Smile Hotel Naha City Resort, which is the only hotel that has not yet returned to pre-pandemic rent, and the recovery of Smile Hotel Osaka Tennoji, where revenue has temporarily declined due to a decrease in Chinese inbound tourists. Additionally, we expect internal growth driven by the introduction of variable rent at several properties. In the office sector, we also expect an upward trend as we close the widening rent gap and shorten rent-free periods. On the financial front, while rising interest rates will inevitably increase debt costs, we believe that by steadily implementing external growth, and in particular internal growth strategies, we can achieve our DPU target of 1,350 yen. Next, I will explain the external growth strategy. Please turn to page 13. As I explained earlier, our immediate portfolio construction strategy is focused on building a portfolio that generates returns sufficient to offset rising debt costs and inflationary pressure. While we do not anticipate making significant changes to the current asset class allocation, we will focus on the terms of the lease and build a portfolio with strong resilience to inflation by increasing the proportion of assets with upside potential, as shown in the pie chart on the right side of the page. In the office sector, we will continue to focus on mid-sized offices with a rent gap, given the limited new supply. In the hotel sector, we will focus our efforts on budget hotels, targeting inbound and business travelers, particularly those with variable rent structures that offer growth potential. Under these strategies, our pipeline is expanding steadily, while the potential future pipeline candidates are also increasing. Please turn to page 14. Under this external growth strategy, we plan to conduct asset replacement during the 21st fiscal period. Specifically, we will dispose of Things Aoyama, a wedding venue with a low yield and limited potential for future rent increases, and acquire Smile Hotel Kumagaya, a budget hotel with promising potential for rent growth. Furthermore, we plan to use the remaining proceeds from this transaction to acquire other properties that similarly offer potential for rent growth. Please refer to page 15, Newly Acquired Asset. I would like to introduce Smile Hotel Kumagaya, which we will acquire as part of asset replacement during the 21st fiscal period. The property is a budget hotel located within 7 minutes walk from Kumagaya Station of JR Takasaki Line, Joetsu Shinkansen, and Chichibu Railway. Kumagaya City, Saitama Prefecture, where the property is located, offers excellent transportation access via JR and Chichibu railway lines, as well as the Kumagaya interchange on the Kan-Etsu Expressway, and has developed as an industrial cluster in the northern Kanto region. Industrial parks are scattered throughout the city and its surrounding areas, making Kumagaya a major industrial hub with the second highest value of manufactured goods shipped in the prefecture. Furthermore, the city is home to a stadium serving as the home ground for a corporate rugby team, and it hosts a variety of sporting events. As a result, while business demand remains the primary driver, the area also holds promise for tourism demand centered around these sporting events. This property features meeting rooms of various sizes and is well suited to accommodate sports teams and group visitors for training. The property's NOI yield after depreciation is high at 4.8%. Furthermore, rent negotiations are possible under the 5-year rent review clause, and we plan to achieve further revenue growth through negotiation of rent terms effective from February 2027 following the acquisition. Please refer to page 18, Pipeline Status. The current pipeline includes 4 properties totaling approximately 15 billion yen. This consists of 3 limited-service hotels in the Tokyo, Kyushu, and Tokai regions, as well as an office property in Kyushu. The projected NOI yield after depreciation for the pipeline is 4.2%, demonstrating strong profitability. As shown in the middle pie chart titled Cash Flow Characteristics, approximately 80% of the pipeline consists of contracts with upside potential. The remaining property is a fixed-rent hotel, but as its lease comes up for renewal in July 2028, we aim to negotiate a rent increase and introduce a variable rent. Our pipeline candidates have been steadily building up, and we will continue to seek assets with upside potential. Please turn to page 20. I will now explain the performance of each sector in the portfolio. First, I will explain the operational status of our large-scale offices. Please refer to the occupancy rate trend in the lower right corner of the page. While the average occupancy rate dipped at the start of the 20th fiscal period at the end of last year, it has since recovered toward the end of the period as backfilling progressed. A notable increase in new lease rents is also evident for the 2 Bay Area offices. As shown in the new lease rent trend in the lower left corner of the page, the rent increases have been accelerating over time. Against this backdrop, the NOI for the 4 large-scale offices is on an upward trajectory, as illustrated by the bar chart in the upper left corner. Please turn to page 21. Next, I will explain the operating performance of the mid-sized offices. The bar charts for each property show the trend in average rent for their respective fiscal periods, while the line charts show occupancy rates. As you can see, average rent continues to trend upward while we maintain high occupancy rates. Furthermore, in the 20th fiscal period, the rent rose by 16.5% for renewals with rent increases, exceeding the rate achieved in the previous fiscal period. It should be noted that the only property experiencing a decline in occupancy rates is Bismix Yodoyobashi. This is due to factors such as the supply of competing properties in the vicinity and our inability to meet tenants' needs for additional space. However, in the general Osaka office market, particularly in the Umeda area, supply-demand conditions are tightening, and tenants face limited options as occupancy rates at newly completed competing properties in the vicinity stabilize. Under these circumstances, average rents are on an upward trend, and we believe it is entirely possible to improve occupancy rates by revising our leasing strategy going forward. Please turn to page 22. This page shows the rent revisions for tenant turnover and lease renewals during the 20th period, broken down by property. Shinagawa Seaside Park Tower to Tokyo Front Terrace are classified as large-scale offices, while those beyond that are mid-sized offices. Although the rent revisions tend to be higher for mid-sized offices with a wider rent gap, there were multiple double-digit rent increases at large-scale offices as well. The table in the lower right shows average rent revisions for the 20th period and the 21st period onwards, respectively. Against the backdrop of continued rent increases, the revisions for the 21st period onwards exceed those of the 20th period. For reference, the most recent new leases for MIRAI's Bay Area offices have reached 20,000 yen per tsubo. At this time, I will explain the rent gap for each property. Please refer to page 35 of Section 3, Portfolio Management, under Status of Operations, Office 4/4. The bar chart in the lower left corner shows the rent gap by property. While the gap is narrowing slightly for some mid-sized offices, where rent increases have been achieved through lease renewals, the gap for large-scale properties is widening due to the recovery in market rents. As shown in the chart in the upper left, the gap continues to widen across the entire portfolio. Please turn to page 23. Next up are retail assets. Following the successful leasing of vacant units at MI Cube Machida East at higher rent, the property has reached a 100% occupancy, with average rent per tsubo reaching the highest level since acquisition. Additionally, Ion Kasai, whose lease incorporates sales-based rent, variable rent was generated for 6 consecutive periods. As a result, as shown in the graph in the upper left corner of the page, total rent revenue for the retail sector as a whole is on an upward trend. Please turn to page 24. The hotels continue to perform well. The table on the left side of the page classifies hotel properties by lease type and cash flow characteristics. To date, we have transitioned a total of 4 properties to leases that include variable rent upon maturity. We are currently negotiating to apply variable rent to properties whose leases expire within this year as well. Furthermore, we are negotiating to switch several properties with fixed rent leases that do not expire for some time to variable rent leases, with the aim of capturing further upside. Please turn to page 25. The bar chart in the upper left corner of this page shows the performance of variable rent for variable rent hotels. You can see that Smile Hotel Naha City Resort, whose recovery had lagged behind others following the COVID-19 pandemic, is now showing signs of recovery, and that variable rent at Smile Hotel Hakataiki Mai is growing rapidly. The top right of the page shows the changes in monthly rent for Smile Hotel Kyoto Karasuma Gojo and Smile Hotel Osaka Tennoji compared to before the operator change. The introduction of variable rent in conjunction with the operator change has resulted in significant rent increases during peak seasons. While there are months during off-peak seasons when rent falls below the previous level, the total annual rent for both properties combined increased by approximately 155 million yen. Furthermore, although Smile Hotel Osaka Tennoji was affected by a decline in Chinese tourists, annual rent remained above the previous level, and the yield has improved significantly. Since there are 4 fixed-rent hotels whose leases are set to expire by the end of 2027, we plan to introduce variable rent for them as well to further expand leasing business revenue. For your reference, please take a look at the trends in the guest demographics at Smile Hotel Osaka Tennoji. Please refer to page 36 of Section 3, Portfolio Management. At the top right of the page, you can see the trends in the hotel's guest demographics. While the number of guests from Asia, including China, has declined significantly since last December, the number of guests from other regions and domestic travelers has been on the rise. This indicates that the hotel's shift in its target customer base is yielding some positive results. Please turn to page 25 again. Please refer to the operational status in the lower left corner. Hotel Sun Route Niigata has generated upside rent for 3 consecutive years, and N Hotel Issei has also generated variable rent due to the impact of events related to the Issei Grand Shrine's Shikinen Sengu ceremony. In Okinawa, both domestic and international visitors are on the rise as the number of flights recovers, and variable rent is also increasing. Furthermore, we recently completed a facility renovation, and with the reconstruction of Shuri Castle set to be completed this year, we can expect further recovery. Please turn to page 26. This page shows a year-on-year comparison of the RevPAR trends for each property over the past year through April. Although RevPAR at Smile Hotel Osaka Tennoji, on the top right, has been below the previous year's levels since November last year, the gap has not widened. The other properties generally outperformed the previous year. please refer to Financial Strategy on page 27. As shown in the financial highlight on the left, support of our financial institution partners has enabled us to maintain favorable financing terms, with an average debt duration of 6.6 years and an average interest rate of 0.98%. The LTV stands at 49.1% based on total assets and 44.3% based on appraised value. While the proportion of fixed-rate debt is currently relatively high at 85.6% of the total debt, we plan to incorporate floating-rate debt for the time being, taking into account interest rate trends and the revenue structure of our assets. The maturity ladder is shown in the lower right corner of the page, and we will continue to focus on diversifying repayment schedules. Page 28 shows the trends in the average financing term, average interest rate, and LTV. We structure our debt to maintain the same duration even as interest rates fluctuate. While the financing costs are on the rise with higher interest rates, we have maintained the spreads. As for the LTV on the right, you can see that while we have maintained our total asset LTV at 50% or below, the appraisal LTV has been gradually decreasing in line with the rise in appraisal value. We remain committed to maintaining a financial structure that does not hinder the stable operations. Finally, I would like to explain our progress on ESG initiatives. We have long regarded ESG as a key priority, and we have now launched initiatives to further enhance our commitment. Please turn to page 46 of Section 4, ESG Initiatives. In March of this year, we established targets for reducing greenhouse gas (GHG) emissions and a roadmap for decarbonization. This policy was established following approximately 1 year of deliberation, with the aim of mitigating the risks that climate change poses to real estate values, and by extension, to unit holder value, while also identifying opportunities to enhance value. Our midterm target is to reduce GHG emissions by 36.3% by fiscal year 2035 compared to fiscal year 2024, and our long-term target is to reduce them by 90% by fiscal year 2050. That concludes the presentation of the financial results for the 20th fiscal period. The strong office market is clearly benefiting MIRAI's portfolio. While we must continue to monitor the impact of the situation in the Middle East on the hotel assets, which constitute the second largest asset class after offices, the latest news suggests that conditions are beginning to improve. In this environment, we will prioritize raising rents for the core office portfolio above all, while in the hotel sector, we will achieve internal growth by increasing rents through the introduction of variable rent structures at contract renewals. We sincerely appreciate your continued support and look forward to your ongoing guidance. Thank you very much.